podcast. All right. We good to go? Yes. All right. All right, thank you guys for joining. I'm just waiting to make sure everybody's here and all our social medias are live. So we got the TikTok, we got 2 Instagram, Facebook. Also, we got the YouTube live. Here's the thing. Here's a little tip for you guys. Doesn't matter which platform you're seeing us. If you want the best sound quality, obviously this professional mic and all the sound system is connected to our YouTube live. So we're working on centralizing everything, but currently, because the rest of them are through our cameras and our phones, straight from there, you might hear me a little bit far. But if you really want to hear the best sound quality, go to our YouTube. They're all under the same username, Realtor Mehrooz, Mehrooz. Doesn't matter which platform. Go there and you can hear the sound quality way better, more of a professional sound. And then obviously the edited version of each episode is going to be uploaded in the next coming Friday of each episode. Let's say today we're filming this on Wednesday. By next Friday, this episode is completely edited and uploaded in our YouTube channel under our playlist for Modern Choice Financial Podcast. Without further ado, let's just start. Welcome to Modern Choice Financial Podcast, where we talk strictly about real estate, mortgage, insurance, and how the market is doing. If you guys been following us for the last however many episodes, hopefully you're one of those that asked your question out, and we're basically basing our future episodes based on what's been mainly asked. So we had a couple of episodes about different part of the insurance industry. Obviously, myself, Mehrooz, as the real estate, mortgage, and insurance broker here in the state of Nevada, I'm completely capable of talking about these 3 industries and these 3 topics. So anything that is kind of outside of my profession, I bring the guest. For instance, we had people from inspection, from appraisal companies, from a couple of different lawyers, from title companies. And if you guys been following, hopefully you can remember those episodes. If not, I highly suggest go watch them. They're loaded with all kinds of great information. With that being said, during the 2 episodes that we had for insurance industry, one of them was mainly focused on home and auto. The other one was mainly towards like financial and life and all the financial side of the insurance industry, for retirement plan and all the other stuff. We have a lot of questions, so I'm going to go over as much as I can, and then if you guys still have more questions, obviously I'm going to bring the guest again into our future episodes, and we're going to dive more deeper in those topics. Today I decided to dedicate the topic to how your homeowner's insurance would have an effect on your mortgage, if you have mortgage. Obviously, in the state of Nevada, just like many other states in this wonderful country, mortgage companies, because they want to make sure they stay as a first lien on the property. Pay attention to that, it's very important. Because of that, they want to make sure there is no other lien whatsoever on that property, especially anything that is government lien, like tax lien, right? So anything that's government lien always become superior, become basically the first lien on any property. With that being said, they want to avoid the taxation for property tax to put a lien on the property, and eventually they can actually foreclose on the property if they have to, right? Because they want to get paid. Therefore, they made a decision that, you know what, we'll handle it for you, Mr. and Mrs. Homebuyer. We're going to create an escrow account, which is almost like a saving account within your mortgage company. Every time you guys send your mortgage, it goes to 4 different pots minimum: principal, interest, tax, and insurance. Obviously, principal and interest is the money that you borrowed. The other 2 part, tax and insurance, is property tax and homeowners insurance. In some cases, when you guys paid less than 20% down payment on that home, you have what's called mortgage insurance. What is mortgage insurance? Again, the mortgage company, because you don't have enough equity in the property, they call that loan a high risk loan. Therefore, they want you to purchase a mortgage insurance. So if something happened to economy or something happened to your family, for whatever reason, you cannot pay that loan off, they have a insurance that you purchase and you pay, and that insurance would comes in and kind of like cover them and pay them off, okay? And obviously, if the loan is FHA loan, that mortgage insurance, it stays there forever. On conventional loans, if you built in 20% equity, let's say you bought a house at $500,000. 10% of that is $50,000, right? 20% is $100,000. So if your home increased the value from $500,000 to $600,000, you already have a 20% equity on that property or more. Then you can call your mortgage company and ask them to remove mortgage insurance. And normally what they do is they send the appraiser to your property, and then they're going to appraise it just like you're literally buying it again, right? And then if the appraiser shows that yes, the actual value of your home in today's market is appreciated about 20%, you now have basically about 20% or more equity in the property, then they're going to take that mortgage insurance away if you have a conventional loan. Or maybe the home is not really appreciated as much, you just won the lottery. You just had some other properties or some other money, you inherited some money, and you just want to lower your mortgage, and you injected that money into your loan. Let's say you owed, to begin with, you owed $450,000. Now you paid about $100,000, and there's a trick to that. You have to call the mortgage company when you're making that payment. You have to make sure it goes directly to your principal. And then after that, there's a term called reamortization. So you need to ask them to reamortize your loan because you paid a big chunk of money towards your principal balance. Now, instead of $450,000 that you owe $350,000. And moving forward, what's going to happen is if you actually know what to do and how to basically talk to them, and they are willing to do that, it's like it says in Bible as well, you don't have because you don't ask. If you ask and they give it to you, then they're going to reamortize your loan, and eventually your mortgage payment comes down. So these are the benefit of being a homeowner. And you always have a chance to lower your monthly payment versus on the reverse side, when you're renting, unfortunately, there's only one chance your rent keep going up. So with that being said and aside, let's go back to our original topic. So let's go back to PITI, principal, interest, tax, and insurance, which is the original full element of your mortgage. In some cases, as I said, if you have mortgage insurance, then obviously you pay 5 different things in your mortgage, which eventually you can eliminate the last one, which I just explained how. So now, if you have your home in one of those states like Nevada, that there is a escrow account for your mortgage company, and mortgage companies collecting the money every month. Obviously, for your first year, when you purchase the property, at the close of escrow, they call it closing costs. What is your closing cost? First year of property tax, first year of property insurance, closing fee, doc fee, recording fee, title insurance fee. Now that we just brought it up, what is title insurance? If you go back to our previous episodes, we had a whole episode about it and why it's so important. Title insurance, just to sum it up really quick now that we're in this topic, it's basically an insurance that is on the title of the property, that is kind of like suggested. It's not really mandatory, but it's highly suggested to have. Let me kind of explain it in a quick example. Let's say you're buying this property right now. When they run what's called preliminary title report, when the escrow open at the title company, it shows that there's no lien, there's no legal issue on this property, everything is good to go, and the property supposedly get transferred to you from the seller to you as a buyer without any what's called cloud or any legal issue. Meanwhile, after the preliminary report was done, the seller was kind of involved in some sort of lawsuit or some sort of legal issue, or maybe didn't pay something and they had the home as collateral, and then they start going through the legal process and they start basically put a lien on that property. And meanwhile, the property is going through a sale and it never came up. It's not that they didn't do their job as title company or escrow company. It just wasn't recorded as a lien on the property yet. And here we go, you buy the property and 2 weeks later you get a notice that there's a lien on this property. That's why that mortgage company would require you or make you get that title insurance to make sure if anything happened ever, legally, you have some sort of insurance that would pay for that, basically clean it up. So going back to my first topic, mortgage companies, since they're the one that actually lend you the money to buy this property, usually in most cases, probably anywhere from 95% to 75%, if you're getting a loan, is the loan amount. Depends on how much you put down. Obviously, the biggest risk is on the lender. So they want to make sure that they stay as in first lien, first right. That's why they want to make sure that taxation is cleared. So the money that you send to your mortgage company every month as in mortgage payment, it goes to this 4 or 5 different section. Principal interest gets paid, obviously, for them. If there is a mortgage insurance that gets paid, what's left is your property tax and insurance. So since you already paid for the first year in advance during your closing cost, your second year is getting deposited every month through your payments. It goes and sit in that escrow account, or AKA kind of like saving account for your home within the mortgage company. So when the renewal time comes or the anniversary of your sale comes, the insurance company need to get paid to renew the homeowner's insurance. Meanwhile, you've been paying that slowly every month to your mortgage company, and it's deposited to that escrow account. Same thing, property tax. So that's how mortgage company making sure that the property tax on this property is paid, so there's no issue with taxation. Also, the property has proper coverage on their homeowner's policy. It's not basically what's called underinsured. Let's say if the reconstruction value of this property would be $450,000, insurance reconstruction or dwelling coverage basically is at $450,000, nothing lower than that. Because if anything happened to that property, let's say, I don't know, you had a guest, or somehow you come home, you were a little bit tired, you just fall asleep, you were smoking, all of a sudden the house is on fire. The cigarette fall on your carpet, and before you know, the house is on fire. By the time fire department comes and do what they gotta do, half of the house is gone. So now homeowners insurance comes in and pay. Or what if by the time they come, the whole house is burned down, right? That's why you have homeowners insurance, and that's why it's mandatory from your mortgage company to have one, and they have to be one of the beneficiaries on that. So if anything happens, since this is not your home yet, free and clear, they want to make sure that in the event that some sort of a craziness happened like that, insurance company would pay for that and they get paid. Other than that, it's fairly simple once you understand the logic behind it and how it works and how not. Here at our office, since we're basically set up as a multi-service office, we have a mortgage room, we have a couple of offices for our real estate, and also this section right behind me is basically our insurance division. We get a lot of calls, if not on a daily basis, I'd say at least 3-4 times a week from different mortgage companies that, hey, we're the new mortgage company and we need the updated deck page or declaration page for this home. Here's what really is going on behind the curtain. Usually, if you're paying your mortgage on time within first 6 months to a year, and in some cases actually within probably first 3 months, your loan gets sold to other company. And it happened a lot. Don't be surprised if it happened. Your loan getting sold to other company or other servicing company, and they're not allowed to change your rate, change the term, or how much you owe on the property. Everything remains the same. If your interest rate to begin with was like, let's say 6%, the next company that's going to buy that mortgage from the previous mortgage company is going to keep it the same. Everything the same, the term, how long is left for your mortgage. Let's say you already paid 2 years, you have 28 years left. Everything remains the same. The only difference is now there is a new sheriff in town, new company basically, and that company needs to be listed in what's called mortgagee clause. Remember that word. What is mortgagee clause? Mortgagee clause is the address that insurance companies use to send their bill, their invoice every year for renewal. So now, here we go. This is a common issue. People get notified that Mr. or Mrs. Homeowner, I'm the new mortgage provider for your property. Here's the new loan number. Here's where the address is to send your future payment. Just to let you know, from now on, I'm your mortgage company. Usually this happens within like a 30 to 45 days notice. Basically, your previous mortgage company send you a notice that we're transferring your loan to other company. What that means is they sold your loan. I mean, we don't want to go too deep on that. It's all about finance and financial industry. The projection is, like they call it, pro forma of your loan in the next 28 years that's left, or 30 years, is they're going to collect this much on interest. That's the money that they earn from lending it to you. Based on that, the other company comes and say, hey, I pay you $20,000 in advance and buy that loan from you, because if I have this loan, I paid you $20,000, but in the long run, I'm going to make $200,000 out of this loan. That's pretty much how it works. So now you, as the homeowner, hopefully this is the entire purpose of this episode. I really want to make as much information out there for you guys, so you have a understanding of how it works. And remember, if something happened in that line of happening into your life, you know how to deal with this, and you remember, oh, I remember Mehrooz was talking about this, so I know how it works now. If your mortgage company changed, let's go back. Let's just start fresh again. What should you do when your mortgage company change? Your old mortgage company send you a letter or notice that starting from next month, this is your mortgage provider. By law, that new mortgage company needs to send you a notice as well. Now you know from this point on, here's a new loan number, here's a new company, and that company 120% sure have what's called mortgagee clause. And as I explained earlier, mortgagee clause is the address that is utilized between the insurance company and mortgage company. It's a specific address. This is different address than where you mail your check, if you're still mailing your check to your mortgage company. It's a whole separate address only for that escrow account that we were talking earlier, or for their insurance department within that mortgage company. When, insurance company would send the invoice to that address to the mortgage company insurance department, they open the invoices. That's all they do all day, like receiving all these bills from all these different borrowers. And they say, okay, well, they seems like their insurance went up this year. Okay, well, let me see if we have enough money in our escrow account. If there is enough money, they just write the check and pay the insurance company. If there's not enough money, meaning the projection was the insurance and tax remains the same. But as we know, since we're in inflation and everything is keep going up, as property values are going up, the tax on the property goes up too. So now the money that was originally supposed to be in your escrow account within your mortgage company is not sufficient, because they projected that since last year the tax and insurance was this much, hopefully it's going to remain the same, but we're in a totally different market. Things are growing value-wise, and because of inflation, everything is have a higher charge. So if the tax on that property have a higher amount, and also insurance went up, so therefore there's not enough money now sitting in that escrow account to pay for both. So what's going to happen is, either they're going to tell you, hey, this is the anniversary of our mortgage and your escrow account is a little short. Now you know why. When you receive a letter, it's a whole separate letter from your mortgage company that, hey, there's a shortage in your escrow account, don't go crazy. Listen to me and you know exactly what is going on. As I just explained, that letter should ring the bell that, oh, okay, looks like my insurance went up or my tax went up. It's like 99% chance that's what it is. There's nothing else that might cause that, right? So if your insurance went up, unfortunately, you have two options. you either send a separate payment to your mortgage company, and again, a lot of people's they're more technology savvy, and they can just go online in that mortgage company's portal, and when you send the payment, there's an option. You want to send it as a regular payment, or you want to send it only to principal or only to escrow account. If you have your online portal for your mortgage, it's there. It's very simple. But if you're just like, I don't want to deal with that, just call them. You can just call your mortgage company and tell them that, hey, I received your letter. Apparently, there's a shortage in my escrow account, and I just want to make the payment towards my escrow account. So that is not going to count as your regular mortgage payment. It goes right to your escrow shortage. So it will cover that shortage. So now, let's go to the most important topic for today. What should you do to lower your insurance, homeowners insurance, or at least prevent it from going higher? Let's talk about it. You can have a lot of different sensors. For instance, you can have a water shutdown sensor. A lot of companies provide that. Ring is one of them. You can have that. It's like $50-$60. It's a very, very good investment in your house. Even if it's a couple $100, it's still worth it, because what if you have a leak in your house? What if one of your pipe bursts? Instead of entire house get flooded, and beside the fact that now it's hard to live in that house until everything gets dried, all your belongings are wet, and also the damage is sufficient enough that you have to use your homeowner's insurance to pay for all that, and it's just a mess. You don't want to be there, right? It could have been prevented with that little water shut-off sensor. Or if you have security alarm. Let's say, again, I'm not a Ring promoter, but I used to have Protection One. I use ADT. Obviously, comparing to Ring, their price is a lot higher. So I love Ring. I have it in my office. I have it in my house. I have it everywhere. So if you have that, you can prove you have the Ring protection or any sort of alarm security, that's another discount. But you have to be able to prove it. Okay. Another important one is the smoke detectors. Now, there's a lot of new version of the smoke detectors that they have like a new batteries that last like the whole 10 years, a whole decade. Okay. And not only they detect a smoke, they detect carbon monoxide, which is a dangerous gas. So that would be another addition that you can add to your home. Is for your own safety, and also with the proof of that, we can lower your insurance. Also, every insurance companies, if you stay loyal to them for at least 3 years or more, they have a loyalty plan, and that will lower your homeowner's insurance. Here's another thing that you can do. It's highly suggested. This case happened as we talked today earlier at our office. Two of our clients, when they got their auto insurance with us, unfortunately, whether they didn't want to talk about it, or maybe at the time they bought their auto insurance from us 2 years ago or 3 years ago, they weren't a homeowner, they were just a renter. But then they bought a home from whoever, and they didn't pay attention. Nobody explained it properly for them that, hey, if you want, you can bundle it with your auto insurance, so you have a multi-policy discount, and it will be a cheaper policy for your homeowners. So today we just discovered two of them, and they were so happy during our routine call for their renewals. So we just realized that the address changed. There's a home address. Previously was an apartment. And yeah, I just bought a home. And I'm like, okay, well, how come you didn't tell us anything? Yeah, I mean, my lender took care of it for me, which is pretty normal. But I think where the ball was dropped was that lender should have asked the borrower that, hey, you have a car, I'm assuming that you have insurance on it. If your company, your insurance company provides homeowners insurance, do you want to get a quote? We could have given them a very good quote, which we did today, but it could have been done earlier. That's what I'm trying to tell you. So that's another way for you to lower your homeowners insurance, which directly affects your mortgage payment. So as I said earlier, PITI, principal, interest, tax, and insurance. Obviously, when your insurance portion, it's not going to be a dramatic change, but it helps, especially for some families that they're barely making it every month. $50 less or $100 less that pays for somebody's cell phone bill or pay for the gas. Or either way, why should you pay extra when you have a chance not to pay for it, right? That's the whole point. Other than that, I think I covered a lot today. I don't want to make it like a 2 hours conversation. If you guys have any more question or there's an area that I forgot to cover, please comment below wherever you're watching the video. I would love to answer it all. Don't forget to like, subscribe, and share with your friends and family, whoever you care for, especially in our YouTube channel. We put a lot of time, effort to have as much as possible our informative videos. We have a lot of short videos about a quick little topic, like a tip of a day. I personally come usually on Sundays. I shoot some videos when there's, everybody's are out there playing their stuff. This is my hobby, basically. And I do it with a lot of passion for you guys as my audience to make sure I have enough information for my current and future clients. With that being said, that will conclude today's episode. Please let us know if you have any further questions so we can answer them all. And see you guys in future episode. Ciao. All right.